Before money was a coin, before it was a banknote, before it was a number on a screen, it was something much older. It was trust. It was memory. It was a promise that one person could give to another, and that both could believe would still matter tomorrow. Money has taken many forms across human history: grain, shells, silver, gold, stone, paper, plastic, and now invisible numbers moving silently through global networks. But behind every form of money, there has always been the same quiet question: what do we value, and who do we trust? In this story, we will travel gently through the long history of money, beginning as far back as the evidence allows. Not only in one country, not only in the modern world, but across ancient Mesopotamia, China, India, Africa, the Mediterranean, the Islamic world, Europe, the Americas, the Pacific, and into the digital age. This is not a story of charts and markets. It is a story of people, of farmers and merchants, of rulers and workers, of temples, empires, caravans, ships, banks, and ordinary hands exchanging value across time. We will move slowly and carefully, and only where history gives us something real to stand on. Because money is not just something we spend. It is one of the oldest ways human beings have tried to remember, measure, exchange, and trust. So settle in, and let us begin at the beginning, before coins, before paper, before banks, with the simple human need to remember what was given, what was owed, and what still held value. This is the history of money. Before money was a coin, before it was a banknote, before it was a number glowing softly on a screen, money was a way of remembering. It was a way of saying, "This has value." It was a way of saying, "I owe you." It was a way of saying, "This thing I hold can travel from one hand to another, from one village to another, from one harvest to another, and still be trusted." Money, in the deepest sense, is not only metal or paper or code. It is a human agreement. It is memory made portable. It is trust given shape. And because humans have lived in many places, under many skies, beside many rivers, deserts, forests, mountains, and seas, money did not grow in only one place. It did not belong to one country, or one empire, or one language. The history of money is not the history of the United States. It is not even only the history of Europe, or China, or the Middle East, or Africa, or India, or the Americas. It is a human story, and like all human stories, it begins before anyone wrote it down. So we begin carefully. We do not know the very first moment when something became money. No one was there with a pen. No scribe pressed a note into clay saying, "Today, money begins." The earliest people traded, shared, gifted, borrowed, remembered, and repaid in ways that left few traces. A meal shared around a fire does not fossilize. A promise between neighbors does not last for 10,000 years unless someone records it. A favor returned after a season leaves no coin in the ground. So the beginning of money is wrapped in silence, but the silence is not empty. Archaeology gives us fragments: clay, shell, stone, metal, bone, tablets marked with signs. We cannot always hear the voices of the people who used them, but we can see the systems they built. And one of the first things we learn is this: money did not begin simply as coins. Coins are latecomers. Before coins, there were accounts. Before money was stamped, it was counted. Before it could jingle in a purse, it could be owed. Money is often described as doing several things. It helps people exchange goods and services. It helps people store value for later. It gives people a common way to measure prices. It can also record debts and payments over time. These ideas sound modern, but their roots reach very far back. Imagine the earliest farming communities of the ancient Near East. Not a city yet, not an empire yet, but a world of fields and animals, of barley and sheep, of seasons and storage. People were no longer only moving through landscapes in small bands. In more and more places, they were staying. They were planting. They were harvesting. They were keeping animals. They were storing food. And when people store food, they must remember. How much barley is in the storehouse? How many sheep belong to this household, or this temple, or this group? Who delivered grain? Who received grain? Who owes what after the harvest? In the ancient Near East, long before alphabetic writing, small clay tokens were used to count and account for goods. Different shapes could represent different things, such as measures of barley or animals. The system lasted for thousands of years, and scholars have connected it to the development of early writing in Mesopotamia. This is one of the most peaceful and profound images in the story of money. Not a gold coin, not a bank, not a stock exchange, but a small piece of clay held in the hand. A token, a little shape that says, "Remember." A cone, perhaps, for a measure of grain, a sphere, perhaps, for another quantity, a disc, perhaps, for an animal. The object itself was simple, but the idea was enormous. Because once value can be counted, value can be remembered. Once value can be remembered, it can be transferred. Once it can be transferred, it can become part of a system larger than one person's memory. Eventually, some tokens were sealed inside clay envelopes. Marks were pressed on the outside so the contents could be known without breaking them open. Over time, impressions and signs became more abstract. The old physical token began moving toward writing. And so, near the beginning of written history, we find not poetry first, and not philosophy first, but accounts. Goods delivered, goods owed, goods received. This is not cold or unromantic. It is deeply human. It means that people were already living in webs of obligation. They needed fairness. They needed memory. They needed a way to say, "This happened, and we agree that it happened." In Mesopotamia, the land between the Tigris and Euphrates rivers, clay tablets became a durable record of economic life. Many surviving tablets are administrative or legal documents. Shipments, deliveries, sales, wages, loans, debts, inheritances, lawsuits, and more. In this world, silver and barley served as media of exchange, units of account, and stores of value from the 3rd millennium BCE onward. Listen to that gently. Silver and barley, one shining, one living, one drawn from the earth in metal, one grown from the earth in grain. Barley could feed you. Silver could be weighed and stored. Both could be counted. Both could settle obligations. This is important because it reminds us that money has not always been something separate from life. Money was food. It was metal. It was an entry on a tablet. It was a measure, not a thing you carried every day. In Mesopotamia, a shekel was not originally a coin jingling in the hand. It was a weight. Silver could be weighed out. A piece might be cut from a coil. The value was in the measured metal, not in a stamped face. The Institute for the Study of Ancient Cultures describes Mesopotamia's adoption of a silver standard that equated measures of barley with a set amount of silver, including examples of silver coils from which pieces could be snipped to pay debts. A coil of silver, a scale, a debt, a tablet. A person standing in a courtyard, perhaps, while a scribe marks clay. We do not need to invent a character. We can simply notice the evidence. People borrowed silver. People borrowed barley. Loans carried interest. Laws tried to regulate interest. Debts could become crushing. Debt cancellation appears in records. The quiet world of accounting could become a world of pressure, fear, and release. Already, at the beginning, money is double. It is useful, and it is dangerous. It helps strangers cooperate. It also allows debt to grow. It creates memory. It can also trap people in memory. Every later chapter of money will repeat this pattern. Money opens doors, and money builds walls. Money allows trade across distance, and money concentrates power. Money feeds cities, pays workers, funds temples, funds armies, builds roads, crosses seas, and sometimes breaks families. This is why the history of money is not only economic history, it is moral history, it is political history, it is spiritual history, it is the history of trust. From Mesopotamia, let the mind widen. Not every society followed the same path. There was no single ladder that everyone climbed, from barter to shells to coins to paper to banks to phones. Human beings are too creative for one simple path. Across the world, many things became money-like because people accepted them as valuable, countable, recognizable, and transferable. Cattle, grain, salt, cloth, metal, shells, beads, tea, stone, paper, and later entries in ledgers, and later still, electrical signals moving between institutions. A useful form of money must do a delicate thing. It must be special enough to be valued, but common enough to circulate. It must be recognizable. It must be difficult to fake. It must survive handling. It must carry meaning. This is why shells became so important in many parts of the world. A small shell can be beautiful. It can be counted. It can be carried. It can be strung. It can travel farther than the shore where it was born. Cowrie shells especially became one of the most widespread forms of money-like objects in history. The Smithsonian notes that small seashells are durable, portable, and difficult to imitate, and that cowrie shells circulated as a medium of exchange across Asia, Africa, Oceania, and North America. Hold that image for a moment. A shell from the sea, traveling inland. A bright, smooth object, moving through hands that may never touch the ocean. In some places, cowries became everyday exchange. In others, they were ceremonial, symbolic, or part of wider systems of wealth. On Africa's western coast, cowries were used as money in historical periods of trade. In Asia, cowries and imitations of cowries appear in long monetary traditions. In Oceania, shells were part of complex systems of status and exchange. A shell is small, but it can carry a world. It carries the sea into the marketplace. It carries distance. It carries beauty. It carries trust. But here, too, we must be careful. Not every valuable shell is simply money. Not every object used by Europeans as currency had the same meaning in indigenous societies. Take wampum, for example, the shell beads associated with native peoples of the eastern woodlands of North America. It is often repeated, too casually, that wampum was simply Indian money. But that is misleading. In Munsee and neighboring indigenous societies, wampum held great value, but it was not merely money in the everyday European sense. It served spiritual and ceremonial purposes, signified authority, and was used in diplomacy, especially in belts, whose patterns helped preserve memory, law, history, and meaning. In colonial contexts, Dutch and English authorities assigned exchange values to wampum. But that should not erase its deeper indigenous roles. This is one of the most important lessons in the whole history of money. An object can be valuable in more than one way. A shell can be a price. A shell can be a promise. A shell can be a memory. A shell can be sacred. A shell can be all of these, depending on who holds it and why. Now, let the story drift across the Pacific to Yap in Micronesia. There, one of the most famous forms of traditional money was not small at all. It was stone. Rye stones, also called fei, are large stone discs from Yap. Some were enormous, too large to move easily. The Bank of Canada Museum explains that the biggest rye were often used for high-value or culturally significant purchases and ceremonies, while smaller forms of local currency could be traded directly for goods and services. This seems strange only if we think money must be pocket-sized. But money does not always need to move physically. Sometimes what moves is ownership. If the community knows who owns the stone, then the stone can remain where it is. The record lives in public memory. A rye stone can sit still while value moves around it. This is not primitive. It is sophisticated. It shows us that money is not the object alone. Money is the recognized relationship between people and the object. A stone too heavy to carry can still be money if the community remembers and agrees. And in a way, that is not so different from modern money. Most money today is not carried in the hand either. It sits in ledgers. It sits in bank accounts. It sits in databases. It moves because systems agree that it has moved. A great stone on Yap and a number in an online bank account are not the same thing, of course. But both remind us that money lives partly in shared belief. Now let us return to East Asia, where one of the world's longest and most influential monetary traditions took shape. In ancient China, cowrie shells were used early, and over time, metal objects came to imitate or replace earlier forms. Chinese coinage did not begin as round coins only. It included objects shaped like tools, spades, and knives. The American Numismatic Association notes that bronze spade and knife money appeared around the 7th to 6th centuries BCE, followed by the round cast metal disc with a central hole that became a long-lasting form across East Asia. This is a beautiful development. A tool becomes a symbol. A spade, once used to dig, becomes a metal sign of value. A knife, once used to cut, becomes a form of money. And then, slowly, the form becomes simpler. Round coins, cast in metal, with a hole in the center. The hole mattered. Coins could be strung together. Value could hang in loops. A string of coins could be counted, carried, stored, and paid out. With the Qin unification in 221 BCE, Chinese money moved toward a standardized round coin with a square hole. Over centuries, this form became one of the most recognizable monetary shapes in the world. A circle with a square at the center. Metal shaped by authority. A little object that could travel through markets, taxes, salaries, shops, and households. China's monetary history shows how money and state power often grow together. When a state standardizes money, it does more than make trade easier. It tells people what counts. It tells people what will be accepted for taxes. It spreads the image and authority of rule into daily life. Every coin is a message. Some coins carry a ruler's portrait. Some carry inscriptions. Some carry symbols. Some are plain, but even plainness can be authority. Now, far to the west of China, another transformation was happening. In western Anatolia, in the region associated with ancient Lydia, small pieces of electrum, a natural alloy of gold and silver, were weighed, marked, and stamped. The American Numismatic Association places the invention of coins in Asia Minor during the 7th century BCE, and notes that the first coinage identifiable with a kingdom comes from Lydia, with coins featuring the head of a lion. This is one of the great turning points. A lump of metal has value because of its weight and content, but a stamped coin adds something else: a sign, a guarantee, a public declaration. The stamp says someone with authority stands behind this. Someone has measured this. Someone has marked this. Trust becomes faster. Instead of weighing raw metal every time, people can begin to rely on the mark. Though, of course, marks can be abused and trust can be broken. The Lydian lion, pressed into metal, tells us that money is also communication. A coin travels farther than a king's voice. It may pass through hands that never see the palace, never hear the language of officials, never meet the ruler whose authority it carries. Yet the coin speaks. It says, "This belongs to a system." Coinage spread through Greek cities, Persian lands, and the wider Mediterranean world. It did not replace all older forms at once. For a long time, weighed metal, local exchange, credit, and coin all lived together. Monetary history is rarely a clean replacement. It is usually a layering. Old forms remain. New forms arrive. People adapt. Across South Asia, coinage also developed in distinctive ways. In ancient India, punch-marked coins are generally treated as the first documented coinage, appearing between the 7th to 6th centuries BCE and the 1st century CE. These were mostly silver, marked by symbols punched separately onto the coin. These coins did not look like later portrait coins. They were often irregular in shape. They carried symbols from nature, geometry, and authority. They belonged to a world of trade, cities, guilds, local states, and eventually empires. It is calming to imagine them not as museum objects, but as handled things. A small silver piece, a mark of the sun, a tree, an animal, a hill, a symbol whose meaning was clear to people then, even if it is quieter to us now. Money always carries symbols from the world that made it. In one place, a spade. In another, a shell, a punch-marked sun, a ruler's face, sacred words. The materials change, but the deeper question remains: who will accept this, and why? As coins spread, they changed the texture of daily life. They made some transactions easier. They helped rulers pay soldiers. They helped states collect taxes. They helped markets grow. They helped empires move value across distance. But coins were never just convenience. They were power. To mint a coin is to make a claim. A ruler who mints coins says, "I can define value. I can command metal. I can place my symbol in your hand. I can collect taxes in this form. I can pay armies in this form." In the Roman world, coinage became one of the visible signs of empire. Roman coins carried images of emperors, gods, victories, buildings, and messages of power. A small coin could announce a conquest, a succession, a religious message, or a promise of stability. But metal money has a vulnerability. Its value can depend on trust in its purity and weight. When states face pressure, they may reduce the precious metal content of coins. They may stretch the supply. They may change the standard. And people notice. They always notice. A coin may shine, but trust is the true metal inside it. The same lesson appears in many civilizations. A coin is a promise made in metal. If the promise weakens, the coin may still circulate, but uneasily. Now let the story move into the Islamic world. In the late 7th century, under the Umayyad Caliph Abd al-Malik, Islamic coinage underwent important reform. Gold dinars from this period, such as a dinar minted in Damascus in 696 to 697 CE, carried inscriptions rather than figural imagery. This matters because it shows that money can express not only state power, but religious and cultural identity. A coin can say who rules. It can also say what is sacred. Arabic inscriptions on gold and silver coins moved through markets, cities, caravan routes, and ports. They passed through hands in lands connected by trade, pilgrimage, scholarship, taxation, and administration. Gold dinars, silver dirhams, copper fulus, each coin had a place. Each moved through a world of bazaars and caravanserais, through cities like Damascus, Baghdad, Cairo, Cordoba, Nishapur, and beyond. But again, coins were only part of the story. Merchants moving across long distances often preferred not to carry heavy metal if they could avoid it. Metal is useful, but it is also dangerous. It attracts thieves. It is heavy. It can be lost at sea. It can be seized at borders. So human beings developed another kind of money. Money as instruction, a written order, a bill, a letter, a promise payable elsewhere. In the medieval world, across both Islamic and Christian trading networks, credit instruments helped merchants transfer value across distance. In later medieval Europe, the bill or letter of exchange became one of the most important written instruments of interregional and international finance, allowing a payment in one city to be settled through agents in another city at an agreed exchange rate. This is a quiet revolution. A merchant in Venice does not need to carry a chest of coins to Bruges. A banker's book can speak. A letter can travel. Trust can be written. And if the letter is trusted, value moves without metal moving. This is not yet modern banking in the full sense, but it is one of its ancestors. Money becomes more abstract, less weight, more record, less metal in the hand, more trust in names, signatures, seals, reputations, and courts. Now we come to China again, because China made one of the greatest leaps in the history of money: paper. For centuries, Chinese coins were made with holes so they could be strung together, but strings of coins are heavy. Large transactions could require many strings, and carrying them over long distances was cumbersome. In late Tang times, merchants began using receipts from deposit shops. In the Song dynasty, authorities developed and then took over systems of paper certificates, producing the world's first government-issued paper money. Imagine the relief. Instead of the weight of metal, a sheet. Instead of thousands of coins, a note. Instead of value carried on the back, value carried in writing. Paper money asks people to trust differently. A coin made of bronze or silver has material value. Even if the ruler falls, the metal remains. But paper is fragile. It can burn. It can tear. It is worth little as material. Its value comes from the system behind it. This is why paper money is such a profound invention. It reveals the secret that was always there. Money was never only the thing. It was always the trust around the thing. The Song world was commercially vibrant. Trade expanded. Cities grew. Markets deepened. A money supply made only of metal could be inconvenient. Paper answered a need, but it also created a new risk. If too much paper is issued, trust can fade. If redemption fails, confidence can break. This will become a recurring theme in history. Paper is light, trust is heavy, and every paper money system must carry that weight. When travelers from other parts of the world encountered Chinese paper money, they were astonished. To people used to coins and bullion, state-backed paper could seem almost magical. But it was not magic. It was administration, authority, law, habit, and belief. It was a society agreeing that a marked piece of paper could stand for value. This idea would travel slowly. Europe would not adopt banknotes in the same way for centuries. But once the idea took hold, the world of money would never be the same. Let us pause for a breath. By now, money has taken many forms: clay tokens, barley accounts, weighed silver, cowrie shells, wampum belts with meanings beyond money, rye stones, Chinese spade and knife money, round coins with square holes, Lydian electrum, Indian punchmark silver, Roman imperial coins, Islamic dinars, bills of exchange, Chinese paper money. This is already a global story, and we are still far from the modern world. Now let us follow the trade routes of the medieval and early modern centuries. Markets grow in the Mediterranean. Caravans cross deserts. Ships move across the Indian Ocean. Gold travels north and east from parts of Africa. Silver moves through empires. Spices, silk, porcelain, textiles, horses, grain, sugar, and enslaved human beings become entangled in the painful expansion of global trade. Money follows all of it. It enables beauty. It enables violence. It enables connection. It enables exploitation. No honest history of money can be only serene, even if the telling is gentle. We can speak softly and still tell the truth. In West Africa, cowries were woven into trade systems for centuries. They were light, countable, and recognizable, but their value could shift depending on supply. When European traders brought large quantities of cowries into African markets, they affected local economies. A thing can serve as money for a long time, but if supply changes dramatically, value changes too. This is another recurring lesson. Money depends not only on beauty or usefulness, but on scarcity and confidence. Too few units can make exchange difficult. Too many can weaken value. Every monetary system must balance trust and quantity. In Europe, medieval merchant banking developed around cities such as Florence, Venice, Genoa, Bruges, and London. Merchant bankers did not merely store coins. They moved value through books. They extended credit. They settled accounts. They financed trade. They developed methods of accounting that allowed complicated networks of debt and payment to be tracked. The ledger became a landscape. Columns of numbers replaced piles of metal. The hand that writes becomes as important as the hand that weighs. This is not a small change. It means that money is becoming more and more a matter of record, a name in a book, a balance, a transfer, an obligation. And once money becomes record, distance begins to shrink. A merchant may be in one city, a buyer in another, a banker in a third, and goods somewhere at sea. Money becomes the invisible thread connecting them. Then, in the early modern period, the world is violently and permanently transformed by European expansion across the Atlantic. The Spanish Empire's extraction of silver from the Americas became one of the great monetary events in world history. Potosí, in present-day Bolivia, became one of the major silver centers of the 16th century. UNESCO describes Potosí as a major silver mine of the modern era, and notes its association with globally significant economic changes caused by massive imports of precious metals into Spain. But we must say this gently and clearly. That silver came at terrible human cost. The wealth of Potosí was not just a story of coins. It was a story of forced labor, colonial rule, dangerous mines, environmental damage, and lives consumed by extraction. The mountain gave silver, but people paid. From the Americas, silver traveled through global circuits. Some moved to Europe. Some crossed the Pacific through Spanish trade routes linking the Americas and Asia. Some entered China, where silver became deeply important in taxation and commerce. The Spanish silver coin, known as the piece of 8, or Spanish dollar, became one of the closest things the early modern world had to an international currency. University of London Press notes that pieces of 8 circulated worldwide, helped by large quantities minted and steady coin quality, and were used in many contexts from reserves to taxes to wages across global routes. Think of that coin. Silver from a mountain in the Andes, minted under Spanish authority, carried by ship, accepted in Europe, accepted in the Americas, accepted in parts of Asia. A coin crossing languages, religions, oceans, and empires. It is tempting to admire the global reach of such money, and we can admire the scale of connection. But we must also remember the human cost beneath the shine. Money can make the world smaller. It can also hide suffering under a polished surface. This is one reason the history of money must be told slowly. Not to rush past the people. Not to make wealth seem weightless. Every coin has a source. Every note has an issuer. Every account has someone on the other side. Now, as commerce expanded, states became more ambitious and more expensive. Wars required money. Navies required money. Colonies required money. Bureaucracies required money. Courts, roads, armies, and debts required money. States borrowed. Banks grew closer to governments. Public debt became a tool of power. In Europe, the 17th century brought experiments in paper money and central banking. Sweden is especially important here. In 1661, Stockholm's Banco issued the first real banknotes in Europe. They became popular partly because they were more convenient than Sweden's heavy copper coins. But overissue and loss of confidence contributed to failure. This story is almost a parable. Heavy copper, convenient paper, public trust, overissue, inflation, failure. Again, the pattern returns. Money becomes lighter, but trust must become stronger. After Stockholm's Banco failed, a new institution emerged. In 1668, Riksständer's Bank, today Sveriges Riksbank, was founded. The Riksbank describes it as the world's oldest central bank. A central bank is not just a bank. Over time, central banks become guardians of monetary systems. They manage currency, support banking systems, influence interest rates, and act in moments of crisis. They do not all begin with the same powers they later acquire. Like money itself, they evolve. The Bank of England was founded in 1694 as a private bank to act as banker to the government, and later became the United Kingdom's central bank. Its early years were tied to government finance and war. Here again, money and state power are woven together. A government needs funds. A bank helps raise them. The public lends. Debt becomes organized. Notes circulate. Trust in the state and trust in the bank begin to reinforce each other, or in hard times, test each other. Paper money, banking, government debt, and war are not separate stories. They are one story, seen from different windows. Through the 18th and 19th centuries, another idea grew powerful: the gold standard. Gold had long been valued across civilizations. It's durable, beautiful, rare, and easily worked. It does not rust. It's been used for ornament, ritual, reserves, and money. Under a gold standard, paper money could be convertible into a fixed amount of gold. In Britain, for much of the period from 1717 to 1931, the monetary system operated under a formal or de facto gold standard, meaning Bank of England banknotes could be presented for payment in bullion at a fixed conversion rate. Gold gave paper a kind of anchor. A note was not just paper, it was a claim, a promise that under the rules could be turned into metal. This could build confidence, but it could also limit flexibility. If a country's money supply depends on gold reserves, then the amount of money may be constrained by the amount of gold available and by the need to defend convertibility. Gold feels solid, but monetary life is not always solid. Economies expand and contract. Banks fail, harvests fail, wars begin, people panic. Gold can inspire trust, but it can also become a cage. In the 19th century, industrialization transformed money again. Railways needed finance, factories needed capital, workers received wages, cities expanded, insurance, stock markets, joint stock companies, government bonds, and commercial banks became more important. Money increasingly became not only a thing used in markets, but a vast architecture of claims. Shares, bonds, deposits, loans, notes, checks, bills, ledgers. The modern economy was becoming a layered system of promises. A worker's wage might be paid in coin or note. A merchant might pay by bill. A company might raise money by selling shares. A government might borrow by issuing bonds. A bank might create deposit money through lending. Money was no longer one object. It was a whole ecosystem, and like every ecosystem, it could flourish or collapse. The 19th and early 20th centuries saw financial crises, bank runs, inflation, deflation, reforms, and new regulations. Every crisis taught the same hard lesson. Money depends on confidence, and confidence can vanish quickly. A bank run is fear made visible. People line up because they believe others will line up. They withdraw because they fear there will not be enough. And sometimes, by acting on the fear, they make the fear come true. This is why monetary institutions matter. Not because they are perfect, they are not, but because trust at scale needs structures, it needs rules, it needs reserves, it needs transparency, it needs restraint, it needs credibility, and yet no structure is permanent. The 20th century brought 2 world wars, depression, decolonization, inflation, new international institutions, and the gradual movement toward today's fiat money. After the Second World War, 44 nations met at Bretton Woods in 1944 to design a new international monetary order. The system fixed currencies to the US dollar, and the dollar was fixed to gold at $35 an ounce. The International Monetary Fund and what became the World Bank Group emerged from that conference. This was not simply an American story, even though the dollar sat at its center. It was a global arrangement born from global devastation. The world had seen depression, competitive devaluations, trade breakdowns, fascism, war, and destruction. Leaders wanted stability. They wanted exchange rates that could support trade. They wanted institutions that might prevent monetary chaos from feeding political chaos. Money was being asked to help rebuild the world. For a while, the Bretton Woods system provided a framework, but pressure grew. By the 1960s, there were more dollars circulating globally than the United States could comfortably redeem in gold at the official rate. In 1971, President Richard Nixon ended the dollar's convertibility into gold, and the Bretton Woods system of convertibility came to an end. After that, the world moved deeper into fiat money. Fiat money is not fake money. That is too simple. Fiat money is money whose value does not come from being redeemable for a fixed amount of gold or silver. It comes from law, taxation, central bank policy, productive economies, social trust, and the expectation that others will accept it. The Bank of England explains that fiat money is not convertible into gold or another asset. and that its value relies on public trust in government and monetary management rather than the set value of a physical asset. This is a remarkable place for the story to arrive, from barley to fiat, from a clay token to a central bank balance sheet, from a cowrie shell to an interest rate decision, from a stamped lion to a floating exchange rate. But the thread remains the same: trust, memory, agreement. Now, in daily life, money became more invisible. Checks allowed people to transfer money without handing over cash. Payment cards changed the experience of buying. In 1950, Diners Club launched what it describes as the world's first multi-purpose charge card, and by 1953, it had become internationally accepted in businesses in the United Kingdom, Canada, Cuba, and Mexico. In 1958, Bank of America introduced Bank AmeriCard, described by the Smithsonian as the first general-purpose credit card and the first with revolving credit. It later evolved into the Visa network. A card is a quiet object, small, plastic, almost empty-looking, but behind it is a network, a merchant, a bank, a card issuer, a payment processor, a settlement system, a promise to pay later. The card turns identity into payment. You do not hand over money. You present permission, and the system moves numbers. Then came electronic banking, automated teller machines, wire transfers, and global messaging systems. In 1973, 239 banks from 15 countries formed SWIFT, a cooperative created to transform how value-related messages moved across borders, replacing older telex-based processes. This is one of the least visible but most important changes in modern money. Money no longer needed to travel as an object. Instructions traveled, messages traveled, balances updated, banks reconciled. The world's financial system became a nervous system of messages. A payment in one country could depend on computers, codes, correspondent banks, clearing systems, regulations, time zones, and trust between institutions that ordinary people would never see. Money became faster, but also more complex. And complexity brings both power and fragility. A coin can be held, a banknote can be folded, but an electronic payment is harder to see. It asks us to trust screens, to trust passwords, to trust institutions, to trust that when numbers change, reality has changed with them. In many parts of the world, another transformation came not first through desktop computers or credit cards, but through mobile phones. Kenya's M-Pesa, launched by Safaricom in March 2007, allowed users to send and withdraw funds using basic mobile phones and a network of agents. The World Bank describes it as revolutionizing how Kenyans manage money. This is a vital part of the international story. Modern money is not only Wall Street, London, Frankfurt, Tokyo, or Shanghai. It is also a small shop acting as a cash-in, cash-out agent. It is a worker sending money home by phone. It is a person without a traditional bank branch nearby, still able to participate in electronic payments. Mobile money reminds us that innovation often comes from practical need. People need to move value safely. They need to support family. They need to save, pay, borrow, and trade. The form changes, but the need is ancient. A clay token and a mobile phone are separated by thousands of years, but both answer the same human question. How do we remember value? How do we move it? How do we trust that it will arrive? Then, in 2008 and 2009, another idea entered the story: Bitcoin. Bitcoin was introduced through a white paper under the pseudonym Satoshi Nakamoto and released as open-source software in 2009. The Bank for International Settlements describes Bitcoin as an example of a non-central bank digital currency. Bitcoin did not begin as a state promise. It did not begin as a bank deposit. It did not begin as a coin made of metal. It began as a networked ledger, maintained by participants using cryptography and computing power. For some, it represented monetary freedom. For others, speculation, technological experimentation, risk. We do not need to decide its final meaning here. History is still unfolding. It is enough to place it honestly in the long story. Bitcoin belongs to the ancient question of trust. Can strangers agree on value without a central authority? Can a ledger be maintained by a network? Can scarcity be created by code? Can money exist without a king, a temple, a central bank, or a metal mine? These questions are new in technology, but old in spirit. Because the whole history of money has always asked, who do you trust? A scribe, a temple, a king, a coin, a bank, a government, a network, a community, a line of code. Now, as we sit in the present, money is many things at once. Cash still matters. Coins still pass from hand to hand. Banknotes still fold into wallets. Bank deposits make up much of everyday money in many modern economies. Cards move through terminals. Phones tap silently. International payments move through banking networks. Central banks manage reserves and policy. Cryptocurrencies trade on digital platforms. Mobile money serves communities far from traditional branches. Local currencies appear and disappear. Gold is still held as reserve and memory. Cowrie shells sit in museums, but also in cultural memory. Rye stones remain powerful reminders that money can be public agreement. Old forms never fully disappear. They become symbols. They become lessons. They become warnings. They become heritage. What then is money? After this long journey, we can answer softly. Money is not one invention. It is a family of inventions. It is a tool for exchange, a unit for measuring, a store for waiting, a record of obligation, a language of power, a vessel of trust, a mirror of society. When societies are stable, money often feels invisible. We barely notice it. We tap, swipe, count, send, receive, deposit, withdraw. But when trust breaks, money becomes visible again. Prices rise too quickly. Banks close. Coins vanish. Notes lose meaning. People turn to foreign currency, gold, goods, barter, favors, food, anything stable enough to hold value. In crisis, money reveals itself. It says, I was never only paper. I was never only metal. I was never only a number. I was your confidence in the world around you. That is why inflation frightens people. It is not only that prices rise, it is that memory becomes unstable. The value stored from yesterday does not mean the same thing today. The future becomes harder to imagine. The unit of account, the ruler by which prices are measured, begins to bend. And when the ruler bends, people feel the world bending with it. Deflation can be painful too. If money becomes more valuable over time, people may delay spending. Debts become heavier. Wages may fall. Economic life can slow. Too much money can weaken trust. Too little money can choke activity. The art of monetary systems is balance. But balance is hard because money is human, and humans are never still. We grow, we panic, we invent, we fight, we migrate, we build, we forget, we remember. Money changes because we change. The oldest clay tokens remind us that money begins in memory. The Mesopotamian tablets remind us that debt and accounting are ancient. Cowries remind us that beauty and portability can become value. Wampum reminds us not to flatten sacred and diplomatic objects into simple currency. Rhinestones remind us that ownership can move even when the object does not. Chinese coins remind us that standardization can bind a vast realm. Lydian electrum reminds us that a stamp can speed trust. Indian punch-marked coins remind us that symbols can carry authority without portraits. Roman coins remind us that empire speaks through money. Islamic dinars remind us that faith and inscription can shape coinage. Bills of exchange remind us that writing can move value farther than metal. Song paper money reminds us that lightness depends on confidence. Potosi silver reminds us that global money can be built on suffering. The Piece of 8 reminds us that a coin can become international. Swedish banknotes remind us that convenience without restraint can break trust. Central banks remind us that modern money needs institutions. The gold standard reminds us that metal can anchor money but also limit it. Bretton Woods reminds us that after catastrophe, nations try to build monetary order. Fiat money reminds us that trust can exist without convertibility into gold. Credit cards remind us that payment can become identity and network. SWIFT reminds us that money travels as messages. M-Pesa reminds us that the future of money can arrive through ordinary phones. Bitcoin reminds us that the search for trust is not finished. Through it all, the deepest truth remains simple. Money is a story we agree to live inside. Not a fantasy, not a lie, a working story, a shared structure, a way of coordinating human life across time and distance. When you buy bread, you do not need to know the farmer. When you are paid wages, you do not need to receive grain. When you save for later, you are asking the future to honor the present. When you lend, you are trusting time. When you borrow, you are bringing the future into today. Money is time folded into an object. A coin is past labor in the palm. A note is public trust in paper form. A bank balance is a promise written in numbers. A debt is a shadow cast forward. A payment is a small release. Perhaps this is why money can feel so emotional. It touches survival, food, shelter, status, freedom, fear, generosity, power, hope. It can be hoarded, it can be shared, it can be stolen, it can be gifted, it can be worshipped, it can be ignored by those who have enough, and painfully present to those who do not. Money is never only economic. It enters the home, it enters marriage, it enters inheritance, it enters worship, it enters law, it enters war, it enters art. It enters the quiet thoughts people have at night. And yet for all its power, money is still a tool. It is not food itself. It is not friendship itself. It is not wisdom. It is not peace. It is a bridge, and like all bridges, it matters where it leads. Across thousands of years, people have tried to make that bridge stronger, lighter, wider, faster. Clay made memory durable. Metal made value portable. Coinage made authority visible. Paper made value lighter. Banking made money expandable. Central banks made systems more managed. Electronic networks made payments faster. Mobile phones made finance more reachable. Digital ledgers made new forms of trust imaginable. None of these solved the human question completely. What should we value? Who should decide? How much is enough? What do we owe one another? No coin can answer that. No banknote can answer that. No central bank can answer that alone. No blockchain can answer that alone. Money can measure prices, but it cannot measure meaning. It can count a house, but not a home. It can price grain, but not hunger. It can pay wages, but not dignity. It can fund a journey, but not tell us where to go. That is why the history of money is not only a march toward efficiency, it is a mirror held up to civilization. When we look at money, we see what a society trusts. We see who has power, what can be bought, what should never have been sold. The reach of states, creativity of merchants, labor of miners, hands of farmers, confidence of savers, anxiety of debtors, ambition of empires. We see the resilience of communities, and if we look closely, we see ourselves. Now imagine the whole story as one long river. At the source, there is no coin. There is a hand placing a clay token aside, so something will not be forgotten. The river flows into tablets, where barley and silver are counted. It widens into shells, moving across oceans and inland paths. It bends around stone discs in Micronesia, where value rests in public memory. It passes through Chinese foundries, where spades and knives become bronze signs, and round coins are strung together. It glitters in Lydia, where electrum is stamped with authority. It spreads through India in punch-marked silver. It passes through Greek markets and Roman roads. It crosses deserts with caravans and shines in Islamic dinars. It becomes a letter in a merchant's hand. It becomes paper in Song China. It becomes silver from the Andes, moving through empire, ocean, and global trade. It becomes a Swedish banknote, convenient and risky. It becomes a central bank, gold-backed promise, post-war international system, fiat currency, plastic card, bank message, mobile money in Kenya. It becomes a digital ledger, and still the river moves. The river is not finished. Perhaps in the future, money will become even more digital. Perhaps central banks will issue more digital forms of cash. Perhaps private networks will grow. Perhaps some people will return to local exchange, community currencies, or commodity stores of value. Perhaps artificial intelligence will change financial decisions. Perhaps climate pressures will reshape what societies value. Perhaps trust will become harder. Perhaps it will become more transparent. We don't know. And because we don't know, we shouldn't pretend. We can say this: whatever money becomes, it will still need trust. It'll need memory. It'll need agreement. It'll carry the marks of human hopes and fears. The future of money will not be only technical, it'll be ethical. It'll ask who is included, who is excluded, who pays fees, who controls records, who can save safely, who can transact privately, who can cross borders, who can survive inflation, who can recover from debt, who can trust the system. These are ancient questions, wearing modern clothes. A farmer in Mesopotamia, a merchant in Song China, a sailor paid in pieces of 8, a shopkeeper using mobile money, and a person today checking a balance on a phone are all part of the same long human attempt to move value through time. Softly, calmly, we can see the pattern. Money begins where memory needs help. It grows where trust reaches beyond family. It changes when trade stretches across distance. It becomes powerful when states accept it for taxes. It becomes fragile when confidence breaks. It becomes invisible when systems work. It becomes painfully visible when they fail. And it remains always unfinished. So, the next time you hold a coin, you are holding more than metal. You are holding a descendant of weighed silver, stamped authority, and ancient promises. The next time you touch a banknote, you are holding a descendant of paper experiments, state trust, and centuries of confidence and crisis. The next time you tap a card or phone, you are touching a system that began, in spirit, with tokens and tablets, with the simple need to remember who gave, who received, and what should happen next. And perhaps that is the most calming thought in this whole long story. Money seems fast today. It seems modern. It seems abstract. But underneath, it is very old. Older than coins, older than banks, older than empires. It belongs to the human need to connect today with tomorrow, to say, I have done this work. This value can wait. I trust that someone else will accept this later, and to say, we remember. Across the centuries, money has been shell, stone, grain, metal, paper, plastic, and code. But beneath every form, there is the same quiet human gesture. Here is something we agree has value. Here is something we will remember. Here is something that can move between us. And as long as human beings trade, save, lend, give, build, dream, and worry about tomorrow, the story of money will continue. Not as one nation's story, not as one empire's story, but as the story of humanity learning, again and again, how to trust across time. That is the history of money, a history of objects, promises, memory, power, trust. And like all histories of trust, it is still being written.